Most people believe economic collapse comes from reckless spending, corrupt leaders, or a sudden market shock, but what if the real force driving global instability is something far more hidden, silent loops inside the financial system that push entire countries into borrowing cycles they can't escape? And what if these loops weren't accidents, but carefully reinforced over decades, shaping your cost of living, the value of your salary, and even the opportunities you'll never know you missed? To understand how these loops formed, we have to return to a moment when the world believed it was building stability but was actually constructing the blueprint for dependence. After World War II, nations demanded a financial system that could prevent depression, manage exchange rates, and support global trade. But behind the idealism at the Bretton Woods conference was the beginning of a structure that linked economic progress to external loans. The International Monetary Fund and the World Bank were created with promises of reconstruction and support, offering countries a path to modernization and global integration. Yet their models depended on lending huge sums of money given to nations that had no choice but to borrow to rebuild their roads, factories, and political credibility. From the very beginning, the world economy was being rewired to grow not through savings or production, but through continuous borrowing. For a while, this seemed not only harmless, but beneficial. The post-war boom produced strong growth, rising wages, and expanding industries. Nations borrowed money, yes, but they were confident that their fast-growing economies would allow them to repay everything. What they didn't see was the emerging pattern. Every slowdown, every crisis, every period of stagnation pushed countries toward the same solution: more debt. The true shift came in 1971 when the United States ended the gold standard, breaking the last physical anchor holding global currencies together. Overnight, money became an elastic concept, printable, expandable, and without gold limitations, borrowing became easier. Interest rates became tools of influence, and global finance became a limitless marketplace where debt was the new lifeblood. Banks recognized a massive opportunity. If money could expand without physical constraint, then lending could, too. International banks flooded developing nations with attractive loans, promoting them as paths to faster growth and modernization. But many of these loans financed projects that didn't generate returns: empty airports, unused highways, oversized power plants, investments that looked impressive but didn't strengthen economies. By the early 1980s, the trap snapped shut. Interest rates surged, and countries like Mexico and Brazil suddenly found themselves unable to pay even the interest on their debt. The 1982 Latin American debt crisis exposed something alarming. Global finance had evolved into a self-reinforcing loop, one in which nations needed new loans simply to pay off old ones, spiraling deeper into dependence with each cycle. When countries approached collapse, institutions stepped in with lifelines, but these rescue packages came with strict conditions. Nations were told to privatize industries, slash public spending, cut subsidies, and open their markets to foreign competition. Instead of escaping debt, they restructured their economies to ensure they would remain dependent on external lending for decades to come. This created an unsettling paradox. Schools, hospitals, and infrastructure budgets shrank as interest payments ballooned. Nations were no longer building for the future. They were paying for the past. Global inequality widened as wealth flowed from developing economies back to the institutions that funded them, creating a cycle in which debt didn't simply grow, it multiplied its own necessity. The same pattern quietly emerged in wealthier nations, but through a different pathway. Consumer credit, the rise of credit cards, student loans, auto loans, and massive mortgages turned citizens into borrowers without even realizing it. Buying became easier than saving, debt became more normalized than cash, and people slowly transitioned from economic participants to financial dependents. Corporations followed a similar trajectory. Instead of expanding through reinvested profits, companies borrowed aggressively because debt was cheaper, faster, and often rewarded by financial markets. Some corporations borrowed not to innovate or hire, but to buy back their own stock, artificially boosting share prices while increasing long-term vulnerability. By the 2000s, the entire world economy had morphed into a web of intertwined borrowing. Governments needed debt to fund budgets. Businesses needed debt to appear competitive, and households needed debt to maintain living standards. Debt wasn't just a tool, it was the invisible architecture holding everything together, even as it created risks no one wanted to confront. When the 2008 financial crisis hit, this architecture was exposed. Risky mortgage loans in the United States triggered bank failures, market turmoil, and global panic. Governments rushed to stabilize their economies, but the only available solution was the one they had relied on for decades: more borrowing. Public debt soared as governments bailed out banks and stimulated collapsing economies. Central banks transformed from regulators into the quiet engines powering the global financial system. They printed money through quantitative easing, lowered interest rates to historic lows, and created an environment where borrowing became not just easy, but practically necessary. What was supposed to be a temporary emergency measure slowly became a permanent mechanism. This environment produced a new kind of loop, one where the world economy could not function without ultra-low interest rates and constant liquidity injections. If central banks raised rates too much, markets panicked. If they didn't raise them at all, inflation surged. Every action carried consequences that forced countries back into borrowing to stabilize their systems. Meanwhile, developing nations faced a new form of dependence. External debt dominated their budgets, with some countries spending more on interest payments than on education or healthcare. Every attempt to grow faced the same barrier: debt obligations that consumed national potential before citizens ever saw its benefits. Then came the pandemic, which accelerated everything. Governments around the world borrowed more in 2 years than they had in entire decades prior. Debt ceilings were raised, deficits exploded, and central banks printed trillions. Nations didn't just borrow to recover, they borrowed to survive. The loops tightened again. Today, the world sits on a mountain of debt, exceeding $300 trillion more than 3 times global GDP. Every country, rich or poor, is trapped in its own version of a cycle, where new borrowing covers the gaps left by old borrowing. Economies don't grow because they innovate. They grow because they borrow. The system isn't broken, it is functioning exactly as designed. The unsettling truth is that the loops persist because they benefit those who can lend. Massive financial institutions, investors, and governments profit from interest, fees, and influence. Debt becomes not only a financial tool, but a geopolitical weapon, shaping alliances, dependencies, and strategic leverage across continents. Attempts at reform have repeatedly failed because any effort to reduce debt threatens the stability of the very systems that rely on it. Reducing borrowing slows growth, slowing growth triggers market panic, and market panic forces governments to borrow again to stabilize the situation. The system cannot change without collapsing, and it cannot collapse without changing. This is why the loops remain hidden in plain sight. They are not conspiracies. They are mechanics. They persist not because someone created them with malicious intent, but because economies have become too dependent on them to survive. Borrowing is no longer a choice. It is a requirement embedded into every budget, every market, and every expectation of future prosperity. Modern citizens feel the effects without understanding the cause. Rising housing prices, stagnant wages, inflation, and diminishing public services are all consequences of debt-driven growth. People work harder while getting less, not because productivity is falling, but because the system channels wealth toward servicing past obligations rather than building future opportunity. If current patterns continue, the next major crisis won't be triggered by a housing bubble or stock market crash. It come from the simple fact that the world cannot borrow forever. At some point, the loops will tighten beyond what central banks can manage, forcing a reckoning unlike anything modern economies have experienced. The first takeaway is that economic growth is no longer organic. It is artificially sustained by borrowing cycles that create the illusion of prosperity. Recognizing this helps decode why the system constantly feels unstable. The second takeaway is that debt is not merely a financial instrument. It is a global structure that shapes national priorities, corporate behavior, and personal opportunity. Understanding it reveals the hidden forces influencing everyday life. The third takeaway is that breaking the cycle requires more than policy changes. It demands redefining how economies measure success, how nations finance development, and how societies value long-term stability over short-term expansion. As the world stands at a crossroads, the future depends on whether these loops continue tightening until they break, or whether new models emerge that reduce dependency without triggering collapse. The path forward is uncertain, but ignoring these patterns guarantees that the next crisis will arrive with even greater force. If you want to understand the deeper mechanics shaping your financial reality and the global events that will define the next decade, make sure you stay curious, stay informed, and keep exploring the truths hidden beneath the surface.